Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is what to expect in banking in 2025. My name is Matt Bisanz, and I'm a partner in Mayor Brown's Washington, D.C. office and a member of our bank regulatory practice. Joining me today is my colleague and fellow partner, Jeff Taft. Jeff is one of the co-leaders of our financial services practice, and he's also based in the D.C. office. There's a lot of predictions that will come over the next year, and some of them may end up coming to fruition, others won't. But now we're creating a record, so you can definitely go back and tell us which ones we did or did not get right. With that said, let's begin. Jeff, I know you do a lot of work with bank partnerships and banking as a service, or BaaS, as the fish store may say. Can you tell us a bit about what is expected to occur in the regulatory sphere for those arrangements?
Sure, Matt. I'm happy to dive into that. I think really you have two types of bank partner programs. You have the BaaS program, as you kind of talked about, which is basically contracting for deposit and other, typical banking product services. And then you have the traditional bank partner program, loan programs that we see between banks and a lot of the fintechs out there. I think each one of them presents some interesting challenges and some interesting things for the coming year. I think in general, the banking regulators, the prudential regulators, at least at the federal level, have really been focused on some of the relationships between banks and these fintech partners. They have, issued a joint statement, around arrangements between banks and third parties, to deliver these deposit products and services, which is really the BaaS programs. And then they've also had an RFI to kind of gather some information about arrangements between banks and fintechs that are offering consumer and commercial banking products to customers. So I think obviously the information gathering stage at the agencies is occurring. But in the meantime, these partnerships kind of go forward. And I'll talk about both the BaaS and the bank partnership programs just in a little bit of detail. But I think on the bank partnership programs, certainly what we're seeing, at the state level is we're seeing increased attempts to regulate these relationships. And that's typically regulating the fintech partners, although there's one exception to that, I think, that we'll talk about in a second. And that's through legislation and licensing, typically, where the legislation at the state level is requiring more of these fintechs to be licensed. We're also seeing still some lingering true lender litigation, both at the private plaintiffs level, but also at the state regulators level, with California obviously being involved in some ongoing litigation right now in the true lender space. I think on the bank regulation side, I think we've seen at least one state, that's Colorado, that's tried to regulate the bank partner through opting out of the DIDMCA interest rate exportation requirements at the federal level. So, Colorado enacted legislation basically trying to get an opt-out of DIDMCA so that out-of-state state-chartered banks could not export interest rates into Colorado. So far, that has been the subject of litigation, and the litigation has actually worked out so far probably in favor of the banks, recognizing at least one court recognizing that loans made by out-of-state state-chartered banks to residents of Colorado may actually be made in the state where the bank is located. Obviously, that makes some sense. So that the DIDMCA opt-out that they thought they were effectuating was really taking the inability of Colorado banks to export rates and fees to the other 49 states. So that's something to carefully watch. That litigation is still ongoing. On the BaaS side, I think what we've seen is a number of enforcement actions at the federal level where the banking regulators have talked about not allowing or the banks are not doing an adequate job of supervising some of their service providers, being the fintechs who are partners to some of these programs. Some of those concerns are around AML, some are around privacy, and some are around cybersecurity, obviously. But that's been a concern of the regulators, and I think that will continue. Although I think if we look back to the original Trump 1 administration, there was certainly much more willingness to allow banks and fintechs to interact. And I think that that's something probably that will also be encouraged in the Trump 2 administration. But again, I don't think that the banking regulators are going to turn a blind eye to fintechs that are providing critical services to banks. I still think there's going to be a careful review of that. Obviously, third party vendor risk management is one of the key concerns of the prudential regulators. And I think in these BAS programs, it certainly comes to the forefront. Um, as these fintechs and these banks engage in these partnerships, I think one thing, and I know this is something you've been focused on in the past, Matt, is whether these fintechs may just say, well, I might as well just go out and get myself a bank charter or partner up, more carefully with the banking regulators so that I don't have to kind of worry about being tangentially regulated. I can be directly regulated. But maybe you want to talk a little bit about that and then maybe the digital asset space too.
Banks and fintechs encountered some of the difficulties that you alluded to, and also some of the complexities of those arrangements. A common refrain has been, "Well, can't I just become a bank?" And for anyone who's been active in the space, you'll know that being a bank is a painful world of hundreds of regulations. However, in the last few years, we've seen a great push towards what I call novel bank charters, which are entities that are a bank but do not engage in all of banking and are not regulated to the same extent as a full service bank. I think one of the ones that the old fashioned ones is the Industrial Loan Company out of Utah and Nevada. That's been a great model for some of the finance lenders. But in the last 10 years, we've seen a interest on the digital asset side of people with limited purpose trust companies in New York, special purpose depositories in Wyoming and Nebraska. And at the federal level, in the first Trump administration, we saw a push around national trust banks and what were called special purpose national banks. And while those didn't really get off the ground, I think, to the way people wanted, I expect to see many applications from fintechs for those kind of models going forward. I also expect to see some of those both in the national trust bank sector and also at the uninsured state bank level. So places like Connecticut's Innovation Charter, that being used by digital asset payments companies and traditional payment companies to obtain Fed master accounts to directly interface with the FedWire and other payment systems. You also see that in Georgia now, where the merchant acquirer limited purpose bank charter has actually been used now. Someone got one for that purpose of access to the payment systems and trying to engage in limited parts of banking, usually avoiding deposit taking, but things like crypto custody, all of that fits more nicely in a banking entity of some type. Uh, the other reason why I think people will be moving towards these novel charters is that the general perception of digital assets as a disfavored activity is changing. At the federal level, we've seen from the recent releases from the FDIC that it was a culture of no, stop, don't do that. And there were numerous letters to that effect. The new administration seems to be saying, yes, we are looking forward to innovation. We are looking forward to experimenting with new types of activities. The repeal of SAB 121 by the SEC again opened the door for banks and broker dealers to more easily custody crypto assets. So I really think that is going to be something where we see more and more activities that touch on digital assets, issuing stable coins, custodying them, even potentially some bank acquisitions of it to say operate nodes. That all of those are things that I think will come to pass under the new administration and sooner rather than later, because unlike some of the other areas of banking that are not a priority for the administration, digital assets is that beyond Elon Musk, that has been a high priority for people like the new leadership of the SEC Trump, even before he got to know Elon Musk, was involved in the space. So it is going to be something the administration pushes forward very quickly. I do think, though, that there are some other legal issues, particularly at the OCC, which will be running point on many of the digital asset activities and the novel charters for things like national trust banks or the recently proposed national payments charter. That they'll have some other legal issues that will keep them busy. Jeff, can you tell us a bit more about those?
Yeah, I think you're right, Matt. I think the OCC obviously will have a big role to play in financial services kind of in the coming years. And obviously, we don't have a comptroller named for the agency yet, so we don't know who's going to head it. I think in the first Trump administration, the OCC was very um, forthright and really did a job to expand some of the services provided by national banks and bring more people into the fold who might charter trust companies and the like, as you were pointing out. Two issues, though, that I think are worth highlighting at this early stage of the game. I think one is federal preemption. So, ever since the Dodd-Frank Act, I think we've kind of been wondering about what is the extent of federal preemption and how much did it really change after Dodd-Frank? Did it change that much for national banks or federal savings banks? And I think the standard that was enunciated in Dodd-Frank, the Barnett standard, obviously is a standard that I think is relatively well known. Um, Kind of expected the Supreme Court last term to kind of weigh in on it in the Cantero case with Bank of America and the escrow, the interest on escrow accounts. Unfortunately, the court really didn't weigh in substantively. They basically kind of punted it back on more of a technical grounds and never really reached anything on the merits. So I think we're still not necessarily quite sure what the Supreme Court thinks about preemption, but we know that obviously they think there's a lot of guidance out there, and the court should look to that guidance. I think preemption will be important in the coming years because I would expect, from everything we heard and have understood in the past, that the states, meaning the New Yorks, the Californias, the Massachusetts of the world, are going to get much more active from an enforcement and a regulatory perspective, and that ultimately is going to lead towards them encroaching on perhaps federally chartered institutions, trying to exercise what we call visitorial powers over some of those institutions. So I do think there'll be an increased focus at the OCC and at the National Bank and Federal Savings Bank level on federal preemption to kind of get around or get through some of those encroachments on the federal banking charters that the states are trying to impose. We've seen one recent preemption case, which is probably worth kind of mentioning. It involves the Illinois Bankers Association and the Illinois kind of interchange prohibition act, which basically prohibited interchange fees on certain types of um, transactions, state taxes and tips and gratuities and the like. Um, One Illinois district court basically sided with the banks, the federal savings banks and the national banks, in basically saying that those were preempted with respect to that because it related to like fee setting by those institutions, and the states can't really regulate that. So it's an interesting and favorable decision from a preemption standpoint. It's just obviously a district court decision. I think we'll see many more cases over the next couple of years based upon what kind of we expect to be happening in the regulatory space. The other area I want to mention, I know this is a favorite of yours, and you've been calling on this one for a couple of months now, is fair access or debanking, however we want to characterize it, choke point or anti-choke point, depending upon your perspective, right? If you go back to January of 2021, the OCC finalized a rule basically that required larger national banks to basically make their products and services available to all customers, and it doesn't seem like an outrageous requirement, but obviously it was intended to basically prevent certain industries and certain types of folks from being debanked or not being able to get banking accounts. I mean, we've seen this throughout history that there's always going to be some sort of either disfavored industry or some industry that presents substantial risks either from a reputational or an AML perspective. So the concept, and we've had choke point 1.0 and now maybe choke point 2.0. So it's not, again, it's not a new concept. I think it's taken on a little bit new meaning in the last couple of weeks. Obviously, there was legislation, around this the first go around, and in the recent Congress, Vice President Vance co-sponsored law along with French Hill and others that would basically put into law this kind of type of fair access requirement. So, it's something to keep in mind. There was a hearing in the Senate banking hearing. I think it was on the 5th of February. So it's obviously risen to that level. I think it's a significant issue, and it appears to be something that the administration wants to have addressed, and something that Congress, at least some members of Congress, feel very strongly about. So I think that's something to keep an eye on, and that's something that we may see in the future. And there could be pushback at the state level for, again, on that type of a law. There's always that push. States have been discouraging, fossil fuel companies and the like, discouraging banks from doing business in those industries, and this is obviously a pushback to that as well. So we're likely going to see a lot more about this in the coming months. But and that's something I think, obviously, you've been pointing out for a couple of months, Matt. So I think you've already been on top of this issue. But speaking of issues you're on top of, and something we spent an inordinate amount of time on since the summer of 2023, maybe talk a little bit about the Basel Endgame and some of the long-term debt proposals that were out there.
Unfortunately, if fair access is the thing that I feel enough people haven't talked about for the future, Basel Endgame is the thing we all talk too much about and won't be in the future. Uh, as most people listening know, there was a capital proposal to increase bank capital requirements in 2023. Huge opposition from the industry. We had subway ads here in DC on Stop Basel Endgame. Huge 300-page comment letters, and rightly chastened the Fed walked it back first in part, and then I think altogether. There won't be a reproposal that advances what were the Biden administration's goals, and it's not even clear that there will be a reproposal that takes more of the Trump administration's goals. That while many of the Trump messengers have indicated that if there is a reproposal, it will be capital neutral, it will be more friendly to industry, and there have been some in industry who have requested that if there is a reproposal, it meet those standards. No one is promising a reproposal. And I candidly think that it would not be in the interest of industry to push for it. That when you think about how long the original proposal was, how much air it sucked out of the room, and it was something that only affects about 30 banks, and it now would be capital neutral, that really raises the question of why even do it. We have other goals to debate, other things industry could ask for. We have, the whole bank merger debate, where we expect to see many more bank mergers come through, merger policy be rewritten, and why waste our time redoing Basel Endgame in an industry-friendly format when, a future Democratic administration could come in and just flip things back. And so maybe don't. It's working now well enough, and let's get on to bigger and better things, is my view. And in the tone of things that aren't bigger and better, also the long-term debt requirements to issue loss absorbing capacity by many of the larger regional banks. I think that might be finalized only because it's more closely tied to the failures of the regional banks in 2023. But even that, I think it's not clear if it will be finalized this year or even next year. So after all of that time we spent talking about it not going to happen, kind of a futile effort on my part. In that same vein of lots of effort for little yield, what's your prediction on the CFPB's open banking or Section 1033 rule?
Yeah, that's a good question, and I think a lot of people are kind of wondering about it. I mean, obviously, the CFPB, and a lot of the rules that they've put out towards the end of the Biden administration have been called into question, either through litigation or just generally subject to scrutiny, perhaps under the Congressional Review Act. mean, 1033, it was the rule was 14 years in the making, and the same day they finalized the rule was the day that a lawsuit was filed. Kentucky Bankers Association and BPI, challenging the rule on, administrative procedural grounds and the like. Ultimately, the outcome of the litigation will depend largely on, on the CFPB. At this point, the CFPB is, with the Treasury Secretary acting as the director right now, has basically stayed and asked for extensions in all of the pending litigation, including, I believe, this litigation as well. Um, I think that the rule itself obviously raised some concerns from the banking industry. I think it is obviously implementing provision of the Dodd-Frank Act, so it is obviously something that is required by the Dodd-Frank Act. I don't think it's something that really would be subject to a Congressional Review Act kind of revocation, but I do think that either through the litigation or potentially just through some sort of intervention by the new CFPB head or the new CFPB leadership, you may see parts of the rule potentially kind of revisited, trying to address some of the concerns that the banking agents, that the banking trades and others have raised. I think because there are some concerns, whether it's about liability and some of the other aspects to it, that I think probably could use a little bit of revisiting or at least some more clarity. So again, I think it's something to watch in 2025. I think the rule at some point will ultimately, in some form, probably an altered form, move forward, and we'll have quote unquote open banking. I guess the question really is, what is open banking? And when you look at our rule compared to what's going on in the UK or the EU, obviously we've approached it in a little different way. And the way we go about setting standards and the like, I think is also kind of interesting. And that's something that's also subject to a different rulemaking as far as getting standards approved by the CFPB. So something to watch in the coming year, but I think it's actually a very interesting topic. And I think a lot of clients, both fintechs and banks, are kind of eager for some movement in a positive direction. And I guess, maybe to round this out, Matt, maybe we circle up with the FDIC. And I know they had a number of proposals out there at the end of last year. They certainly went through a number of meetings and tried to get a number of things done. But maybe talk about some of the deposit related ones, because I think those are of interest to a lot of our clients.
Thanks. Yes, I agree. They are that we do a ton of work with different types of deposit programs. And so when the FDIC in July of 2024 proposed changes to the brokered deposit regulations, we all kind of groaned. It would have largely reversed the 2020 rulemaking that liberalized brokered deposits or made it easier for banks to take them. And really, it would have just implemented what Marty Gruenberg had wanted in 2020, but couldn't get because he was in the minority. Then he was in the majority in 2024, and so he decided to try to undo that 2020 rulemaking. Um, but it was too late. That proposing something in July when your party loses the presidency in November means it's probably not going to get finalized. And so it was not finalized. There were lots of comment letters saying it shouldn't be changed, and I think it's unlikely to ever be finalized, given that he has now departed the FDIC. And even among the Democratic Party, there isn't a huge focus on brokered deposits as a problem. That while it was something that was at various points one party, the other bipartisan, it really was something particular that he was focused on. And so I'm not even sure that a future Democratic chair of the FDIC would expend political capital on trying to redo that regulation. The other proposal that he put forward that does still have some legs is around deposit record keeping. And in September of 2024, the FDIC proposed new record keeping requirements that for banks that maintain custodial or omnibus deposit accounts that have transactional features. And so think here about your traditional for the benefit of account that you might see a money transmitter have, but it's not just money transmitters. It's anyone who has pooled cash accounts for the customers where you can transact in them. It would have required much greater detail in terms of record keeping by the third party holding the pooled account. And it would have also required the bank to reconcile with that third party on a pretty much a daily basis. So huge operational requirements to reconcile these accounts. It was largely intended to address the bankruptcy of Synapse, which was a fintech that was managing several banking as a service programs, like Jeff talked about earlier. And its insolvency created the problem of one, Synapse didn't keep good records of which customers owned which money. And two, the week after it went bankrupt, it actually turned off the servers with the database of which customers had which money. And so even if the banks wanted to return the money, they didn't know who it belonged to because no one had a record. And so this proposal was intended to address those concerns. I think that while it was good natured and does have some degree of bipartisan support, it included, I'll say, punitive requirements around, like, an annual compliance certification, and other terms that aren't necessary to operate the deposit insurance system. So while I think this could be finalized, there would probably be a stripped down version that focused more on solving the Synapse problem and less on finding new ways to penalize banks. That, I think, though, is the main areas that the FDIC will be active in, and I won't even bother trying to talk about what they'll do on the Community Reinvestment Act, because that could take up its own program. So I think that's pretty much it for us today. Thank you, Jeff, for joining me in this episode, and thanks to our audience for listening. If you didn't tune in, we wouldn't have a reason to do these programs. If you do have any questions about today's podcast or anything else related to financial services, please feel free to contact Jeff or myself. We're easily findable online, or email us at gfm@mayorbrown.com. Thank you and have a great day.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.